and welcome to the podcast Bites by India Law LLP. I'm Om Nishad and today we'll be discussing about RBI's new dividend framework. India's banking sector just had a quite powerful shakeup, but most investors haven't noticed it yet. On March 10, 2026, the Reserve Bank of India issued a new set of directions that completely rewrite the rulebook on how banks pay dividends. We are talking about rules that directly affect how much money actually goes back to the shareholders, and more importantly, which banks will be able to pay at all. This is the RBI drawing a clear line in the sand between strong and weak ones. So if you're holding bank stocks or you're thinking about it, you need to understand what has changed. Let's break it down. So for a bit of context, back in November 2025, RBI had issued a framework. Let's call it 2025 directions, laying out the rules for banks to declare dividends. But after receiving the stakeholder feedback and further consultation, RBI decided to scrap it and make a new set of rules. These directions apply to a wide range of institutions such as commercial banks, small finance banks, local area banks, and etc. and will be applicable from financial year 26-27 onwards. RBI has explicitly stated that these obligations and liabilities under the previous directions are fully preserved, so no one gets a clean slate just because the rules have changed. But going forward, the game is about to change. Let's get into the game. Change number 1, the dividend gap. Under the new rules, commercial banks, small banks, and financial payment banks cannot pay more than 75% of the profit after taxes in any given year. Regional banks and local banks get a higher ceiling limit of 80%. What sounds straightforward, but here's the catch. The 75% cap is a maximum. What you actually get to pay depends upon the second most important factor. Change number 2, your dividend depends upon your capital. This is a big one. For commercial banks, the maximum permissible dividend is now directly tied to the bank's common equity tier 1 ratio, or CT1 ratio as we call it. This is the purest measure of a bank's core capital. The equity can absorb losses without the bank collapsing. The higher CT1, the more you can pay out. Banks with a CT1 of above 20% plus the buffer required for systematically investment and protective banks can actually pay up to 100% of their adjusted profits. But banks whose capitals are barely below the regulatory minimum won't even be allowed to pay dividends. For small finance bank and payment banks, it's the tier 1 cap ratio that matters. Because under the old CRR metric, different metrics, same principle. Your position determines your dividend eligibility. Change number 3, adjusted profit after tax. This is a crucial one. RBI hasn't just capped dividends, it has also changed how profits are calculated for dividend purposes. So, under the new rules, the bank must deduct 50% of its non-performing assets as bad loans from its reported profit before it can calculate the dividends. This is what RBI calls an adjusted PAT. So, if a bank reports, say, 1000 crores of profit but has 400 crores of NPA, it can only count 800 crores as an adjusted profit base. After deducting rupees 200 crores, which is the 50% of the NPA, this is what you calculate the dividend from. The RBI is saying, don't show me accounting profits, show me the real sustainable earnings. Now come to change number 4. Not all income qualifies. RBI has also drawn hard boundaries around what kind of income can be used to pay dividends. Exceptional one-off income, not eligible. Audited layer reports, not eligible. Unreleased gain on level 3 financial instruments, those complex asset value models, not eligible. This is a clear message. Dividends must come from recurring, reliable and audited earnings, not just tricks. What this means for the banks? Now let us zoom and ask, what does all this mean in practice? The banking sector is actually in a strong position right now. Gross NPAs have fallen to a multi-decade low of just 2.1%. Net NPAs are just 0.5%. The average CT1 ratio for Indian banks is approximately 14.7%. and commercial banks have recorded 4.1 lakh crores in financial year 25 alone. So for most large and well-capitalized banks, particularly the stronger public sector and the top private sector names, the new rules unlock higher dividend potential. But the banks with the CT1 ratios comfortably below the thresholds, it's a bit difficult for them. The weaker banks, those with a higher NPA or thinner capital buffers, this framework becomes a constraint. If your capital ratios are barely above the minimum, you don't get to pay the dividends at all. And top of that, RBI retains the right to restrict the payouts. If a bank under supervisory action, this is a framework that rewards a capital discipline and punishes the balance sheet weakness. As for investors' implication, what should investor take away from all of this? First, the valuation needs to be seen with a new lens. Nifty index trades at a PE of around 14.4, higher than the broader industry average of 12.6. But with the new names like SBI having a PE of 10.7, India Bank 9.5, and many PSU banks looking attractive under the new framework, the capital position could translate into better dividend forward. Second, watch not just the CET1 ratio, just the earnings. In the past, investors looked at the CAR and the NPAs, but now CET1 is the headline number. Before any banking stock for dividend income, check whether the CET1 sits relative to the new thresholds. Third, don't expect a dividend boom sector-wide. Analysts believe that even though 75% of the payout is capped to provide flexibility, most banks will remain conservative in capital management. The sector-wide payout isn't expected to surge. What we are more likely to see is a divergence for stronger paying banks and weaker banks paying less or nothing. Fourth, these rules take effect from the financial year 27. So the real test becomes when the dividends are declared for financial year 26 and 27. Markets have time to price in these. But the re-rating of the banking stocks based on the capital equity is still under the way. As for closing, RBI's new dividend framework at its core is a statement of priorities. Financial stability first, shareholder return second. By anchoring payouts to CET1 ratios, adjusted profit, and clean earnings, the regulators are ensuring that India's banking system doesn't hollow itself out by distribution of capital it might need for a downturn. For investors, the key question going forward isn't just which bank is profitable, it's which bank has a capital quality to sustain those profits and return them to the shareholders. That's the new standard, and the banks are clear for that part. Are the ones worth watching. I'm Om Nishad from India Law LLP. We work at the intersection of law, regulation, and commercial reality, and we continue to bring you sharp and timely analysis of the development that matters to the businesses and investors alike. Stay with us as the FIO 27 unfolds. Until the next time, thank you.